Okay, great. Thanks everyone for joining today's reading group. Today we're going to discuss our recently accepted paper, the Journal of Financial Data Science. It's called Meta Labeling, Calibration, and Precision Sizing. The authors are myself, Meyer, and Jog, as well as Ilya Barzi. He used to be the team lead here at Isotonic Regression, or the lead engineer. And I think this is kind of like the final paper in terms of the series that we have built up on meta labeling. And today we're going to discuss all the interesting concepts regarding that.
Perfect. And let me jump in just a little bit. I mean, Ilya couldn't be here today. Ilya now works at Adia. And so you'll see on the original paper that it will say, he's a quant researcher and developer at Adia. Unfortunately, he couldn't be here today. We did ask, but he's doing really important work. And there's a bit of a time zone change and different. So he couldn't be here, but I do want to stress that, he made extremely valuable contributions to the paper. For this paper, all of the authors did an equal contribution of work to the paper. So we're sorry he can't be here today, but we're so grateful that we could still publish this now that he's made the move.
Yeah, just hope I can explain the ideas that he had as he wanted. Yeah. Okay, so first off, we're just going to do a bit of a recap on meta labeling. We're going to talk about the previous research that we have done, just to highlight a bit of the papers, how we started, how we got to this point. Then we're going to talk about the precision sizing, which is kind of how we started with this, and then we saw this need that we can actually calibrate some of the outputs from the secondary model into better posterior probabilities to help with sizing the position. And then lastly, we're going to discuss all the methods that we did and then sum them up in the conclusion and results. So just to give a bit of a background, so Jacques last year wrote a paper called Meta Labeling Theory and Framework, where he dissected meta labeling in a controlled experiment. And since then, we have been building up on that. In that paper, he introduced the concepts of the information advantage that the secondary model brings, as well as modeling for false positives. After that, me, Jacques, and Alpheus Messias, who is a senior lecturer at the University of Stellenbosch, wrote a paper called Meta Labeling Architectures, where we just explored different ways of using a secondary model that's maybe a bit more on specific cases.
Yeah, I think. Sorry, Michael. Let me just give a little bit of the, how our approach to doing this is that, the original ideas from Marcus Lopez de Prado, and it featured in that book, Advances in Financial Machine Learning. And then he also expanded on the idea a little bit in Machine Learning for Asset Managers. Now, his explanation was very, very short, and there were so many questions I think so many people had. And so when I was writing the very first paper, it became very clear, like the different steps we had to solve along the way. And so, when Michal and I were working on it, we developed some new architectures. Those architectures, just in the same way neural networks have different architectures, like you get a feed-forward network, you get like recurrent networks, you get convolutional, and so on, right? The same idea is here, right? Is that meta labeling in itself is a principle, so we are very careful when we're in the papers that we're not referring to the secondary model necessarily as a meta model, because there are lots of different architectures in this theme of meta labeling, right? So in Michal's main paper, it is meta labeling architectures, and so in there we kind of showed that strategy. Well, when you're doing meta labeling, you can split that up between architectures that are trading strategy specific, but also you can do architectures that are feature specific. So depending on how you want to extract information from the features, but also depending on like the style of the primary model. I don't know if you want to add to that, Michal.
Yeah, I think throughout this there was this feature-driven approach and the strategy-driven approach, where there's different ways of using meta labeling catered to the specific strategy or features that you want to exploit. There's also this concept of inverse meta labeling, where actually just fit a secondary model to kind of build information or get informative features that relate to the primary model, and then you can build also a better primary model. The case with meta labeling usually is that we're only really looking to remove false positives, when that is, it's kind of inverse meta labeling. And then, Jock, I think you can also maybe just explain on the ensemble learning paper.
Sure. So again, just on the inverse meta labeling, the ideas for meta labeling is that it just filters out false positives, right? But it also has this section that's not really explored, which is missed opportunities. And so the only way to improve your missed opportunities is to improve your primary model. And so inverse meta labeling is an approach where you use the secondary model to kind of figure out, what features are going to be important. If there's an information advantage present in your data, it means that your primary model could be better, which means you're going to have less missed opportunities, which means you're going to have more observations in the secondary model for it to filter out. So that was this core idea of inverse meta labeling. Then this position sizing paper with the 3 authors that we've just done now was actually supposed to be the 3rd paper. But wow, did it take us a long time to write. It was much harder than we initially anticipated. We got lots of different results. And what we initially set out to do was very different to what we landed up doing. But we actually were writing this paper back in March of last year. That's, I think, when we started on it. And so we kind of finished the ensemble learning meta-labeling paper. And so we did that with Dennis Thum and Paulo. Unfortunately, right now, give me 1 second. Let me just get that paper. I've got it. Got it right here. Position sizing, my papers, ensembles. Right, sorry, my apology. Paulo Baruca, who's an associate professor at UCL. And so, that paper is just really wanted to explore the idea of how ensemble learning and what kind of ensemble frameworks could be used in meta-labeling. The gist of it is that, yes, ensembles add value. You should use them in your secondary models. They also help you to better identify regimes, and they help you to deal better with structural breaks and the problem of non-stationarity. But that's and then we also provide a framework in that paper. The paper's done really well. That's also one of the lead papers. I think it is the lead paper in the latest version of the journal. And so Michael's going to get into one of the next slides where we talk about the full architecture. But there's this big question left of, okay, so you have a secondary model, it spits out an output, and how can we now use that output to size positions, and what kind of position sizing algorithms can we add to that? And so that's what this paper explores.
Okay, thanks, Jock. So I know we've done 2 previous lectures on meta-labeling, but this is just going to be kind of a quick recap for anybody that's maybe new here today, or anybody that's just watching online later. So the idea is we first have this primary model. It can be really any type of model. It can be an econometric model based on fundamentals. In this case, we just use a machine learning model, or the architecture of machine learning model, just to simplify things. So first, we have the input data. These are all your features that you're feeding into the primary model. Then you get an initial output between 0 and 1 in the classification sense. And then you do a recall check just to determine the optimal threshold that you want to trade in this case. And then the model also produces some evaluation data that you can analyze, as well as feed into the secondary model.
I think let me just jump in a little bit, Michal. So I mean, on this idea, right, it's that meta-labeling is a secondary model that sits on top of any primary strategy, and that primary strategy really can be anything, right? In the example we're giving here, we're using a machine learning model, which is M1. So you can just imagine that as it could be econometric rule as well, right? But Marcos originally set out with his thesis of separating out the side of a forecast from the size of the forecast. So the side of the forecast, whether to go long or short, to take a position or not to take a position, or just to go long only or short only, that is determined by the primary model. And then the secondary model determines the size and the probability of success. And so that's a very important distinction.
Yes, exactly. And today's paper is more focused on the second part. So the first, in the primary model, you do the determine the side, and then the secondary model allows for new mechanism to determine the size of the position you're taking based on the outputs of the secondary model. And that's also what we're going to see in this case. So first off, when you're now building the secondary model, you can give all these features into the secondary model. So that's the regional input data, evaluation data, market states, and regime data. For example, I think last week there was this paper that we did training fast and slow, and we see that momentum strategies behave differently and different volatility regimes. And those are some of the example of what type of data that you can include. And then also you can include the confidence of your primary model if it's a machine learning model that you take in, that the secondary model takes into account. Then after that, you would get now your output, which is the model's confidence, and then you can take that model confidence, feed it into a bed sizing algorithm, and then finally have your output, which is just a percentage of capital that you're going to allocate to that specific trade of your strategy. Or you can do kind of just a recall check and either invest everything, which is the all or nothing method, which you're also going to get into.
So let me just correct that, Michal. So not a recall check, a threshold check, right? So the secondary model is spitting out a value between -1 and 1, and then you can change that threshold. I mean, it doesn't have to be -1 and 1. That's in the case of a long short strategy. But let's just take a long only strategy where it's 0 and 1, right? And so you may say any forecast greater than 0.5 is a long position, and anything less than 0.5 then must be like a B flat, don't take a position, right? And so that threshold check is, we can change that threshold. So we don't have to say it's 0.5. We can say, I want you rather to only go long, for positions, for events with a greater than a 60% likelihood. And so that's what that threshold check is. You will see this very common in machine learning models for like healthcare and cancer treatment and things like that, because you may want to adjust that threshold for which you say someone, may have cancer. And so before you go and do intrusive examinations, or I don't know, things like spinal taps or very serious treatments, you may want to adjust that threshold. And so, yeah, that's just what that is. And so this paper, of course, is focusing very specifically on that M3 component, right there, the bed sizing algorithms, right? So we're going to take as input the output of the secondary model, and then we're going to figure out, okay, what can we do with this? What are different position sizing algorithms? What are, probability calibration, which is something we explore, and we're going to explain that in the next slide. And so what are different approaches we can do to using that information now to correctly size positions? And the cool thing is you could probably use this just in a primary model. I don't think you'll have the benefit of having a secondary model that filters out false positives, so that would make it more powerful. But I think you probably could use this M3 component just on the output of the primary model. If you wanted to skip that step, I think you'd still see some benefits.
Yeah, so just on that, I think I also forgot to mention the actual target variable is whether the trade is profitable or not from the secondary model. And if you have a machine learning model, then you can interpret that as an estimated probability of profitability. But it's not necessarily probability, but we'll get into that as well with the probability calibration.
Yeah, and those target variables for the secondary model, those are called meta labels. Is a trade going to be profitable or not? That is a meta label.
Yeah, thank you, Doc.
Cool.
So yeah, let's talk about position sizing and meta labeling. So obviously there are a lot of different ways that you can determine how to size positions based on risk, or maximum growth theory, which is kind of on Kelly Criterion side. But in this paper, we're solely going to focus on the secondary models confidence in correctly classifying whether the trade is profitable or not. So the position sizes are solely determined by the model confidence. Now, the greater the model confidence, the larger the position size. I think that's quite intuitive. Obviously, if you're, for example, 80% sure, then you would make a larger position size than at 50%, where you're kind of uncertain about whether the trade is going to be profitable. Now, as we were working through this, we kind of make a distinction between the bed size of position sizing algorithms. Right? So there's fixed function methods and methods estimated from the training data. Fixed function methods just simply take in the output, they're already well defined, and then process them into the position size that you're going to invest in. And methods estimate from the training data, estimate the different parameters of the functions based on the training data. And then we also wanted to ask, does this model confidence need to be a probability? And there's this whole thing about frequentist probabilities, where if a model says spits out, for example, 0.2, then we would expect they only to classify it correctly or to be false positives 20% of the time, right? Or correctly classified only 20% of the time, and that's from in an asymptotic nature if you would continue to do that. But however, as we see, these machine learning models have characteristic distortions in their output.
That's a very important idea. So, I mean, I spent a lot of time working on the Kelly criterion, which I think is an incredible algorithm. I mean, it is a position sizing algorithm that makes the most money by far. It's like a mathematical proof. Nothing makes more money than applying the Kelly criterion. You kind of get the optimal position size to maximize the log of wealth. And so that is a fact. The problem with the Kelly criterion is that, one, it has big drawdowns. And if you're into gambling, you can use that algorithm in playing poker, in blackjack. I think it comes up a lot when you look at card counting. Ed Thorpe, who kind of like invented card counting for beating 21 blackjack. He also did a lot of work. So Ed Thorpe's a fund manager, and he also did a lot of work on the Kelly criterion, and Ed Thorpe's paper is very famous for explaining the Kelly criterion. And so, but you land up with this like one big problem with the Kelly criterion. And that is that in order to apply the Kelly criterion, you need a frequentist interpretation of probability. So you need to know, what is the probability of event A occurring? And then you also need to know, what is the expected profit and loss? Now, the expected profit and loss can be set by setting take profit and stop loss thresholds. So if you set a take profit and a stop loss, you know what the expected profit or loss will be from a trade. But the problem is you still don't know what the likelihood, like what is the probability that the trade will make money. And so ways that people were solving that is either you can use the Kelly criterion in continuous time, which has a bit of a different equation that allows you to override that need, or you can have a look at all your historic trades and you can say, okay, what is my win rate? So, okay, 60% of the time I win. And so you're going to say, okay, there's a 60% likelihood that a trade is going to be profitable. But the problem is that's not a conditional probability. Every single trade we make is conditional on the market regime we're in. What's the volatility? What does the distribution look like? Like there are things that matter for your trading strategy for it to make money. And so meta labeling solves this problem, right? We use the secondary model to give us a confidence value, which is the likelihood of an event. But the problem is we don't have a frequentist interpretation, and so we can't use it in the Kelly criterion. And so there's this need for us to calibrate those model outputs to be a frequentist interpretation of probability. So that was the kind of like underlying thing that interested us so much and that kind of like set us forth on this journey of when we were writing this paper.
Machine learning models don't produce frequentist interpretations of probabilities. As I've mentioned, they have these characteristic distortions. And for example, support vector machines, they push probabilities away from 0 and 1. And we're going to later see when there's histogram, you can quite nicely see how the probabilities are distributed. Well, other methods such as naive Bayes actually push the probabilities closer to 0 and 1. So there's not a lot around 0.5, 0.6. So these models have a certain bias in them. And for example, the support vector machines aren't based on actual probabilities. They just put it into a function for convenience sake to interpret them. And so basically, there's this great paper called Predicting Good Probabilities with Supervised Learning. I forgot the authors now. Is it?
It's in our paper.
Yeah, it's in our paper. But yeah, in that paper, they do a bunch of different machine learning models. They do, for example, neural networks and decision trees, and they found that, and logistic regression as well, and they found that these machine learning models actually produce well-calibrated models just straight off the bat, while other maximum margin methods such as support vector machines have these distortions, and usually a lot of time they have this sigmoidal shape in this curve. Let me first explain what this curve is. So this is called a reliability diagram, and on the y-axis we have the fraction of positives. That's the actual amount that that it classified in regards to the training sample. While on the y-axis we have the predicted probability. So if you look at, for example, if it's perfectly calibrated, and the model says gets confidence of 0.2, we would observe 0.2 or 20% positives. And that's the frequentist interpretation that we are talking about. But for example, in this support vector machine, when it predicts 0.3, it's actually the fraction of positives is only 0.1. So it's basically under predicting the amount of positives. Well, when it's above 0.5, it's over predicting. And from this, it's this has this sigmoidal shape to it. And naive Bayes, on the other hand, for example, overestimates or the true fraction of positives, for example, at 0.1 should be 0.1, but in this case it's 0.4, which can lead to a lot of trouble, especially if you're making a prediction of at the higher levels. If it's 80% of the time, I'm actually I think 80% of the time this trade is going to be profitable, while in reality it's actually only 60%.
Mm-hmm.
So
yeah.
then is
sorry, Michael, finish that train of thought, and then I'll talk about one of the ways in which we came across this was when we were doing ensemble learning, but just finish the thread first.
Oh, so well, basically what I'm getting into next is the calibration methods.
Okay, perfect. So I mean, what happened here is we were thinking about, okay, when I first started earlier on in my career, I thought, okay, well, we can train lots of different ML models on like forecasting the side direction of a trade, right? And then let's just take the average, so let's do an SVM, a random forest, a feed-forward network, a logistic regression, and let's all try to forecast the direction of the trade. And then let's just take the average of all the outputs. Now, when you do that, what you don't realize, or when you do that, you're assuming that the distribution of the outputs for all models are the same. And that became very clear to us when we were reviewing the literature, and we saw that that's not the case. Like naive Bayes will do a lot of predictions very close to 0 and very close to 1, where an SVM will have more of a normal distribution. So if you have those two models and you just say, oh, I'm going to take the average between their outputs, what you're actually doing without knowing it is that you're not doing an equal weighting. You're actually giving more votes to the naive Bayes. The naive Bayes has a larger impact in your forecast than the SVM. And so having a look at the distribution of the model outputs is very, very important for understanding how to build ensembles. And it was from that we realized, okay, well, if we can turn these into probability calibrations, that would have implications for us more on the ensemble learning side, but it will also help us with the position sizing. And so you will see we do reference this paper actually in the ensemble learning paper. So yeah, I thought that was a very good, unique insight, because if you just take the model outputs and say, okay, well, let's just average them, it's not going to do what you think it's doing.
Yes, exactly.
Just one question here. So is this behavior, the naive Bayes and SVM, is the generalized behavior, or this is specific to this particular data set?
No, so that's the generalized behavior. You do have to look at it for each specific problem, but the original paper, I believe, is, let me quickly get it here. It's called Probability Calibration Curves. I think that's the original paper. And let me see here. I'll have to double check for you at the end. But in the original paper, what they do is they have a look at different data sets, they look at different models, and they see what is the general behavior we see across that. So yes, in general, naive Bayes is going to have this like U-shaped distribution, and SVMs, because they're maximum margin classifiers, you're going to get this normal distribution. And so, and like logistic regression is going to be more uniform. And so they explore that fully in their original work. But yes, you still need to have a look for each individual like problem that you're trying to solve, still look at the distributions, but this will give you an idea of generally what happens.
Yeah, I'm just wondering if it's a generalized behavior, why might be the case. Yeah, we need to think about this.
So they explain it in depth in the original papers.
I don't think it's a lot of time it's the case with these types of models that you would see calibration plots like this, but it's also dependent on the assumptions of the model, if they're all true, and what is the actual true underlying model. I guess if you fit if it's non-linear and you fit a linear model to it, you're probably not, for example, when you fit a logistic regression to it, you're probably not going to get a well-calibrated graph.
Yes.
Yeah.
So on that, to correct for these differences in the machine learning models, how they output these model confidence, there are two calibration methods that bring these closer to true posterior probabilities that are perfectly calibrated as can be seen on this line. Well, I mean, they're not perfectly calibrated, but they bring it a lot closer to actual probabilities. So there are two popular methods that are used. The one is isotonic regression, where basically you take your predicted probability and regress it on the true label for different subsets of the predicted probability. So for example, from 0 to 0.2, you would have, and if it's just, a straight line, like normal linear regression. And they call it isotonic because it has to be increasing step function. I like to think of it just as like a piecewise linear spline, right? Where you have all these different splines into it. And then you have these different regression lines, which maps these probabilities into closer to true probabilities. Now, this method is a lot flexible, and it's usually great for when you have large data samples, but it is prone to overfitting. So that's also just a thing to take into account. Another method is flat scaling. And this is also this is very useful for when you observe a sigmoidal shape, for example, as with the SVM here, where basically you just fit a logistic regression of the model confidence against the true labels. Here's an example, just when the calibration is actually applied, how we can see how it changes. So you see most of them are a lot closer. I think one thing to note is, for example, this the naive Bayes, when sigmoid calibration or flat scaling, both the same thing, is applied. It's not that good as with the case, for example, when support vector machines plus flat scaling is applied, due to just on the previous slide, this support vector machine having this sigmoidal shape.
Yeah, the answer to that, right, is that if you have a sigmoidal shape, apply flat scaling. If you have an inverse sigmoidal shape, flat scaling is probably not what you're looking for. Isotonic regression usually works really well if you have larger data sets and you can just make sure you can control for overfitting. It depends. When you're doing trading strategies, you usually don't have a ton of data. right? And so we also know what models to use, right? Like if you're using an SVM, you're very likely to get that sigmoidal shape. If you're using naive Bayes, you're very likely to get the inverse sigmoidal shape. And so you can also choose the models that you're going to use to help you if probability calibration is going to be important to you.
Yeah, right. So just on this, now I think this paints quite a clear picture. So these are just the distribution of the outputs of the different models. So on the left-hand side, we have a support vector machine, and the predicted outputs have more or less normal-like histogram, and we can see when you apply isotonic regression as well as flat scaling, that they push these probabilities closer to 0 and 1. One thing that's also, now, if you just use a naive kind of approach and just use the model's confidence to determine the position size, it's very important to know where most of your observations lie, because if it's around 0.5 and 0.6, that's most of the capital that you're going to allocate, or the position size in that case. Well, for example, if it's naive Bayes and it's it's a lot closer to, there's almost very little between 0.2 and 0.9, but with from 0 to 0.1, there's quite a lot of from the outputs, just the frequency of the outputs, as well as 1. So if you're saying, okay, I'm trading basically above a confidence of 0.5, in case say you have symmetric outputs, then it's going to be that's the threshold that you should trade, because then you're always going, your expected value is going to be positive. But if you have naive Bayes models, you're going to make very large position sizes every time, which you can basically just say at that stage, let's just amount all the capital. So it's just also important to note how the outputs are distributed in the model.
Let me just pause here for a second, Michal. I just want to make sure everyone is on the same track. Maybe we can open up for questions. If anyone has questions, feel free to unmute your microphone and ask. Alternatively, you can post questions in the chat. I mean, this is just coming down to the black bars represent the model outputs, right? On the left, we have the SVM, and on the right, we have the naive Bayes. So here you can see there's very clear shapes I was telling you guys about, where an SVM, maximum margin classifier, so it's going to have this normal distribution type shape, where you kind of have, this one hump, one mode, where with the naive Bayes, we have this kind of U-shaped distribution, right? And so the naive Bayes is pushing the probabilities. When you say to it, hey, give me the likelihood of an event, it's very likely to be very either like bullish or very bearish, right? It doesn't have like a nice in between. Where with an SVM, it's not going to give you these extreme values. It's going to give you values much closer to 0.5. And with ensemble learners, you'll see that same kind of almost normal distribution, right? Because you're voting over lots of different decision trees. And so because you're averaging, you're not landing up with like a lot of these, most of your forecasts are going to be in the middle, and because you're averaging over, you also get that normal distribution type shape, right? And so that's it really. And so this is important because when we're applying a position size based on the model output, the core idea is that we want to, the more likely an event, the more money we want to put on it, right? And so with an naive Bayes, we would make the mistake of being too invested when that doesn't represent the true likelihood of an event, where with an SVM, we'll constantly be taking position sizes not big enough. So that's kind of what's happening here. Does anybody have questions here? Maybe we didn't explain something. Happy to pause here for questions.
Yeah, Jacques, I just have a base question. You can hear me properly, right?
Yes.
Right. If you were to, so there's also the concept that if the model is spitting out values that are too far to the extremes on both either the short or the long, you would probably not want to weigh them as well. So is it, how would you calibrate it so that you find a nice middle ground between the middle values and the extreme values, so that there's a peak in say 0.8 and then it diminishes?
Well, what we actually want to do is we want to find out what the true probabilities is, right? We want the model to tell us that if we go back one slide, Michal, we can just see the probability calibration curves. What we really want is we want our models output to fall on that diagonal line, right? And so if it's doing that, that means it's doing a really good job at getting a almost frequentist. I mean, if it's on the horizontal line, it is giving us frequentist interpretation of probability. And then we can use that in a whole bunch of equations that solves our problem. So that's actually our goal. We do explore different position sizing algorithms, which kind of handle the problem you're talking about, where, maybe you want to, have almost like a sigmoid shape position sizing algorithm, where you say that, hey, if the likelihood is small, I do want you to allocate a larger position size to it, but the more likely your forecast, I want you to kind of taper the size of the position off. So it like accelerates very quickly in the beginning, but then kind of goes slower, right? So you can do things, you can define those shapes up front, right? So maybe you don't want to use a sigmoidal shape. Maybe you say, I much rather want to have like a linear shape. Maybe I kind of like linearly want to scale into the position based on the likelihood of an event. And so those are the things those are the algorithms we also explore in this paper.
Got it. And we can possibly weigh the approximation of whatever we conceptualize by creating a graph like this and seeing how closely it approximates the frequentist probability.
Exactly. I mean, we're really just doing a mapping, right? So if the model gives, maybe you say, I do want to allocate much more to, if the model says 0.8 and then nothing to anything else, right? So you can define a function where, if a model probability is between 0.8 and 0.85, that you're fully invested, else, you're not invested at all. So you as the end user can define that function.
And weigh how profitable it might be in terms of actual backtests and see how that does, as well as the fit to the frequentist probability line in this graph. Got it.
Correct. Exactly. The thing is, if we can get a frequentist probability, then we can start using optimal equations. Then we can start using equations like the Kelly criterion, which gives us the most, it's mathematically proven it'll make the most money. Or we can use risk constraint Kelly, or we can use certain, likelihood. We can even size positions based on the drawdown we want to experience. There's a whole bunch of things that get unlocked if we have a true posterior probability.
Got it. Thanks.
Yeah, right. So here are the methods that we use now throughout the paper. So as I said earlier, we split them between fixed position sizing methods and position sizing methods estimated from training data. And we'll also later see how each of these two groups are affected by the probability calibration. So, the first approach as we thought we would use as the baseline is just this model confidence. Whatever the model's confidence is that we size, that's our position size. And we also made the assumption that we trade only when it's above 0.5. That's basically the assumption that we have some symmetric payoffs. That's not necessarily the case, and we're also going to see later when we change this, how it affects the Sharpe ratio and maximum drawdown. But, we just made this simple assumption at the start. And then next one we did is the all or nothing approach. Again, if it's above a certain threshold, in this case 0.5, we just allocate all the amount of capital. One thing, one thing that we did in the paper as well was we said that no shorting is allowed and no leverage, just to ensure a fair comparison around all these different methods. But obviously they can quite easily be adjusted.
Yeah. Sorry, Michal. Yeah.
No, they can easily be adjusted. Yeah.
The one thing I want to say is this all or nothing approach is usually what you see in trading papers, right? We've got a side from our primary model. It says, either go long or short, and they just immediately say, be fully invested or not invested. I see that in the vast majority of the papers we read. And so now we're starting to say, okay, what are different ways we could do this, right? So one way we can say is, just invest the amount that your model outputs. So that's the model confidence approach, right? If the output of a model is between 0 and 1, any value greater than 0.5 would usually be considered a long position, and anything less than that a short, right? So in the model confidence approach, we just say, well, invest the amount of money which is equal to the model confidence. So if the model is 0.56, invest 56% of your portfolio. So at a minimum, when it's invested, it will invest 50%, and then that can go up. And then again, that's dependent on the distribution of the outputs, right? Some models never make forecasts greater than 0.6. And so that's the problem that happens when we apply this model confidence, is that we constantly are either too invested or not invested enough. And so we're either not using our capital, or it's actually super dodgy and risky. The all or nothing approach, what we see very typically, is either to be invested or not invested. I don't even think you need a secondary model. You're not really doing meta labeling if you're just applying this without a secondary model. And then this normative cumulative distribution function, Michal can tell you a lot more about this, but it was really taken from advances in financial machine learning. Marcos has an equation there where he talks about creating bet sizes, and those it's very closely tied in doing statistical tests for significance on Bernoulli distribution. Is that right, Michal? Yes. And so that's where this equation is coming from. And we did a lot of reading trying to figure it out. I don't think we found like one particular source that explained it very thoroughly. From what we could tell, it had to do with those types of statistical tests.
Yeah, as far as I understand, he called it bet sizing from predicted probabilities. So it doesn't really have a name. That's just all he said, for this formula. And I understand it's basically when you have the null hypothesis that the probability is equal to half. Then you have this Z statistic that you use, and then you just plug it into a normal distribution basically. And in advances in financial machine learning, he exactly uses it like this. So this is when you only have two outcomes, which is in our case, either we're going to trade or we're not going to trade. And so he just plugs this Z statistic in, and then in the normal distribution. And in his paper, he just uses 2 times the distribution, or the probability minus 1. So then it allows for shorting as well. And now we tested this out, and for we use that formula but capped it when it's above 0.5. But then the position sizes were quite small, so we just adapted it to just use the the normal distribution when it's above 0.5, so that we can have larger position sizes. I'm sure you can play around with it, try different ways of also utilizing this.
It's a bit complicated to give thorough explanations, I realize. I mean, the paper explains it much better, so you'll see a lot more of like an in-depth analysis of it there.
Yeah, exactly. So that was for fixed position sizing methods. So just basically you get the output in, and it gives you your position sizing. So these estimated position sizing methods, or when you take the training data, we train the secondary model on and use that data to determine how the function is going to look like. So first off, we have linear scaling, which was basically min-max scaling, and I think with this approach, it may be sensitive to outliers for some strategy, but also it works for when you have very small samples as well. Then the second one, that is the empirical cumulative distribution function. This is also the method that Sharpe used in his original paper. And basically, we was also talking when Ashman asked the question about, we want to give low position sizes or give high position sizes to the model outputs that don't frequently occur but have a high probability, and scale down position sizes with a low model confidence.
Yeah, the intuition behind this ECDF approach is actually quite intuitive, and that is that it has to do with risk budgeting, right? So you've got 100% of your portfolio that you can invest. I took inspiration from work I had seen Marcos doing in advances in financial machine learning, or I remember reading one of his papers and getting the inspiration from it there. And the core idea is that your model makes a forecast of 0.6. But then the question is, how much better can that forecast be, right? If you say 0.6, are you at like the tip of this is the best it ever gets? Because if that's the case, you should be very close to fully invested. But if you say you're at 0.6, but those probabilities, that distribution goes all the way up to say 0.9, then you shouldn't be fully invested now, because the likelihood of it not working out is not that good. But also maybe in your next position, that's the likelihood increases. And so it also allows you to kind of like scale into and out of a position based on how likely it is that it's still going to make money. So it's something that's not just applicable here, but something you can apply if you're just using a primary model. And so that was the core idea behind it, is that, okay, how much money must I hold back so that I can invest more if this position size gets even better? And so that was the kind of like core idea behind it. And then the sigmoid optimal position sizing, Michal might be able to explain that a bit better. I mean, this is an innovation by Ilya, and it's a novel contribution. So we've not seen this anywhere else. Ilya would really be able to explain it in detail, but how much of it are you able to cover, Michal?
No, he explained to me, I think, what was his inspiration, which is basically the shape of the ECDF, which has this sigmoidal shape. So he said, okay, well, let's use this sigmoidal shape and optimize the parameters based on maximizing the Sharpe ratio. And I think that's the basic concept of it. That you, instead of just using the ECDF, you want to maximize the Sharpe ratio, according to this sigmoid shape. Where again, you have, low position sizes for probabilities that occur less frequently and on the extreme there.
Or have high volatility, right?
Yeah. And just on this, he also came up with a method, linear optimal position sizing, where it's more or less the same, but in that case, it's just a linear function instead of this sigmoidal shape. And we'll get to that in the appendix. Okay. So this is just the experiment design. It's very similar to Jock's paper at the start. And basically, we simulate 10,000 observations using an AR3 model, and we do that 1,000 over 1,000 trials. It's just a lot simpler to use kind of synthetic data to avoid stylistic behavior such as heteroscedasticity or volatility clustering. And then we can also control this experiment. I think it's a lot like with this big push for causality, actually making a good experiment or interventional studies and then applying it and seeing actually if it works.
Yeah, exactly right. This is like a randomized trial, right? We've created 1,000 trials. We define what the observations are. We want to show mathematically that this thing works. We could have just as easily done a trading strategy on power markets, shown you how this works, and then shown the same results. But that leaves so many more questions. Does this work on other asset classes? Oh, this works in power, but not for equities. What we really just want to show is that as a technique, this works. And if you apply it, and given that you have got features which are informative of false positives, then this works. And so that's the core idea behind setting up an experiment where we control how the data is generated. We can change things and see how something responds. You see this a lot in Marcus's paper. You see it a lot in the work that we were doing last week when we were talking about momentum turning points, as well as trending fast and slow. You guys will remember that they use a AR1 process where they can control for noise as well as like momentum in the data. So yeah, we're just using an autoregressive order 3 process that allows us to define how much volatility is there. It allows us to define regimes. So there are 2 different regimes that we have in our data. They behave quite differently, and the secondary model is trying to estimate what this function is, right? And so we use a logistic regression. We don't, not in this one, but in the original paper, we used a logistic regression on this linear generated data, and so it's very easy to understand what's going on, and that's the core idea. Of course, in this paper, we're using
logistic regression.
We're still using logistic regression. Thank you, Michal. It's just the calibration techniques. We're swapping between isotonic and sigmoid or flat scaling.
Yeah. Just on secondary, we tried also others, I believe, like support vector machine, decision trees, just to see if there's anything else there. But it was just a quick analysis, and we saw more or less the same results with regards to the box plots, which we'll get to in the results. So just on it, the primary model that was used was basically, they call it this German power, long only. Basically, whatever the sign of yesterday's returns is, that's the side we are going to trade today. So if yesterday was positive, today we're going long. If yesterday was negative, we're going short. But we didn't include shorting this, so just a long only model then. And the calibration that we used for this is isotonic regression. We'll see why we use it when we get to the calibration plot, but as well, I mean, we have 10,000 observations. From what I read, they recommend that when you have above 1,000 observations, then it's preferable to use isotonic regression, as it's just a lot more general model. And if you have fewer than that, and you have that model shape, then flat scaling is preferred. So yeah, all the results from the training set. So we just took one training set out of the sample to kind of see how the calibration affects it, what are the initial outputs or distribution from the outputs. And so in blue here, okay, so on the x-axis, we just have, again, the predicted probability, and on the y-axis, it's just the frequency that those predicted probabilities occur. In the blue is the uncalibrated model, just these raw model confidence outputs that we give, and in the orange, we have the calibrated outputs. Now, for the uncalibrated, we can see it kind of has, I wouldn't say necessarily a normal distribution, but a similar one, maybe a skew to the left a bit. And here you can see that, you know, for example, almost the highest that it goes is up to 0.7. There are very few observations between 0.7 and 0.5, but nothing above that. Well, we have quite a few, for example, that are below 0.3. I think, you know, since we're only trading with a probability of 0.5, it's really important just to, you know, kind of look at the, you know, the probability above 0.5 in this case. And we can see that when we apply the calibration, it, you know, transforms these outputs into higher probabilities. For example, we have a lot above 0.75, and what this means is we basically assigning larger precision sizes to a lot more observations in the case of the model confidence, for example. And also note, you know, when you apply the calibration, fewer samples were actually above 0.5. So we trade fewer times, but we trade with higher probabilities. And then here on the right-hand side, we have the calibration plot for, you know, where we applied the isotonic regression on logistic regression. And you can see this, the logistic regression, you know, there's definitely, it's not very well calibrated. And these points also per decile of the observations that we use. And we can see that, you know, definitely the calibration does bring it closer to, you know, frequentist probabilities. It's still not perfect, but it is a lot closer.
Yeah, so some observations here is that, I mean, it kind of has, in my mind, more of a sigmoidal shape than it does a like an inverse sigmoid shape, and that is because you can see that it, you know, the distance, you know, the only reason why you would say that's not the case is because the forecast on the far left is actually above the diagonal line. And that was actually something we saw a lot, that we've seen a lot in when we're building strategies and stuff, is that when your model makes an extreme forecast, as in that it's in its upper decile or lower decile, actually that has not it's usually like the model is performing well. The forecast, as your forecast increases, the likelihood of the event increases. But then in your last decile and your first decile, they have like quite a reverse direction. And so that's what we're seeing here. We see that relatively often. And that's important, right? Because what that's saying is that, hey, if you go and you say that, hey, the model is extremely confident, it's going to make a lot of money, let's invest in it, you can see that it's actually very, very off. So in this case, I mean, here, if we're looking at the uncalibrated one, it's saying that, okay, well, the mean predicted probability is, 35% or 32%, but the likelihood of actually a positive occurring there is like 45%, so it's a good almost 10% higher, the likelihood of the event. So just be aware of that. And that again is why looking at these probability calibration plots are so important. Even if you don't apply a calibration, just knowing what your uncalibrated curve looks like is going to help you make better decisions.
Yes, exactly. And I think, dependent on what's the primary model, what's the actual series that you're using, or financial time series, and as well as the secondary model, these are all likely going to differ. And throughout our analysis, we just wanted to show kind of the thought process, what you would go through when you are developing, using meta labeling and trying to determine the best position size for your risk tolerance. So the results finally. I think we've talked a lot about the theory. So does this actually work? And so here on the left-hand side, we have box plots of the 1,000 trials for the Sharpe ratio, for normal, just the raw outputs, as well as calibrated. So one thing we can see is for the model confidence, the all or nothing approach, and this normal cumulative distribution function, which are the fixed approaches, or the Sharpe ratio does increase, and it increases on average about 25%, which is quite good. But then for the methods estimated from the training data, they don't actually improve that much. So when you're using these methods, calibration is really not necessary to apply, in this specific case. I guess it could possibly different, but it doesn't really matter. And I think it's just because, for example, in the ECDF, you already scale the outputs differently. It already takes that transformation into account it's really
kind of the difference between rule-based system versus models that have learned from the data. So what you're seeing is that if your model learns from the data, your bet sizing algorithm, if it learns from the data, there isn't a need for you to apply probability scaling, or that impact is much less. And if you're doing a rule-based system such as model confidence, all or nothing, or the NCDF approach, then yes, it makes a big difference. Like if you apply the Kelly criterion, it will make a huge difference.
Yes, exactly. And just on this as well, the ECDF and SOPS approaches produce the best probabilities. The best Sharpe ratios comparatively to the other ones after calibration has applied. And I think that the ECDF and SOPS are quite comparable with respect to the Sharpe ratio. And just looking for something else. And the lowest is basically this all or nothing approach, which is actually, if you think about it, that's the approach, as John mentioned, that's used in the industry, and this is the lowest Sharpe ratio out of all these strategies.
It also has the worst drawdowns, worst variance. I think one of the things you're going to see is that the linear scaling had a very high Sharpe ratio. I think actually, if we look at the median Sharpe ratio done by the linear scaling, it is the best. But what we found is that it takes very small positions. And so it has a really good Sharpe ratio, but really bad expected returns. And so maybe rather using the LOPS method rather than the linear scaling would be better. We do explain the LOPS approach in the appendix. But yeah, so that's just one thing to note. Like, yes, you're going to see the variance is very low on the linear scaling. The maximum drawdown is tiny, but it's because it's hardly taking positions. It doesn't make a lot of money either.
Yes. Also see that for the LOPS approach, I'll talk about, but in that case, we optimized for the Sharpe ratio. A suggestion is maybe to optimize for the returns, but I'll get to that in a sec. So for these rule-based kind of precision size functions, the maximum drawdown improves quite a lot, especially for the all or nothing approach. It still has quite a high variance between the different trials, but it does increase quite a lot, as well as for improve a lot, as well as for the model confidence and the in CDF approach. And then again for the estimated methods, or the methods that learn from the training data. Again, it doesn't make a lot of difference. I guess, in fact, in linear scaling, mean is actually a bit lower across the trials, but I think it's basically negligible. And I would say maybe for the SOPS, there's a smaller variation between the different trials. So on that then, we also wanted to look at the mean return and the standard deviation, break out why is the Sharpe ratio what it is from the previous one. So I guess from this it's clear that the all or nothing approach has the highest mean return over the period, and calibration does also improve that. Then I think about second and third is the ECDF and SOPS approach, with the SOPS approach actually being a bit higher than the ECDF. And then we can also see linear scaling has the lowest, so it gives actually quite low position sizes. But on the right hand side, we can see why the Sharpe ratio is high, because it has a low standard deviation. And just on that, then we can see calibration does not significantly impact, for example, the standard deviation of the model confidence, but it does actually lower it for example, just the all or nothing approach. And so I mean, based on your risk, if you really wanted to go risky, you can go all or nothing, but then you should probably use probability calibration. I would say taking a look at this, but I think if you have to take the trade-off, I would probably use the ECDF or SOPS approach to actually.
Yeah, the ECDF approach is extremely simple, very quick to apply, and it constantly performs well. We saw it constantly performing well, to our surprise, across experiments and trials, across different papers. And so, but the SOPS one, we see so much potential in there. But ECDF is a very super easy thing just to add. Linear scaling, I probably wouldn't apply. I wouldn't apply all or nothing approach. The model confidence approach sounds like it makes good sense, but the problem is you don't really take big enough position sizes. And so I kind of really do lean mostly towards the ECDF, SOPS. Probably I do like the NCDF approach that Marcos put forward. I would also like to see the risk-constrained Kelly criterion in here, which is not something we tested. One thing we didn't mention is that the reason we didn't apply the Kelly criterion here is that in this setting, the Kelly criterion always wanted to, it either didn't take a position, or when it did take a position, it said like go 300,000 times gearing. And we were like, no portfolio manager in the world is going to do that. So it could be just by the function that we use to generate the data, but that's very common of the Kelly criterion, right? Is that it gives you much bigger position size than you'd be comfortable with. And so that's why I think the risk-constrained Kelly has so much potential. And maybe there's even room for a paper just dedicated to the risk-constrained Kelly in the context of meta labeling. And for everyone else's convenience, the risk-constrained Kelly is a Kelly criterion where you can define the maximum drawdown you want your trading strategy to have at a confidence level. So you can say at a 95% confidence level, I don't ever want to draw down more than 10%. Okay, given the likelihood of a positive event, and then the expected profit and expected loss, it will then tell you how to size a position so that happens. And it's a super cool algorithm. So that's something perhaps worthwhile for a future paper. But yeah, in the meantime, ECDF and SOPS, I think are my go-to approaches for things I would use.
Yeah, just on that, I think also, you can use it just like just use the ECDF and then size the positions as well. But you can also use some type of risk management on top of that. But we haven't explored it. We just wanted to isolate this and see how these methods work. So at the start, we basically made this assumption that when the probability is above 50%, then we will actually trade in this long-only model. But then we want to see, okay, but that's quite a naive approach. How does it change depending on the threshold? How does the Sharpe ratio and maximum drawdown, for example, change, both for calibrated as well as uncalibrated? So you can see for the uncalibrated one, in terms of the Sharpe ratio, the threshold is actually about 0.57, where we get the highest Sharpe ratio. But if and that's also even if it's uncalibrated. But when you apply calibration, you kind of have more of a steady distribution in the case where you can't determine the optimal threshold. Now, I looked for a closed form solution kind of for this. I couldn't find anything. So if anybody can come up with the solution to that, please feel free to tell me. But yeah, and then for example, for the maximum drawdown here on the right-hand side, we see that in all cases almost, well, on this graph, that maximum drawdown for the calibration, even if you have a very low threshold of 0.35, is a lot better than for the uncalibrated one. And as we go up, the kind of the difference between them gets smaller.
Yeah, I think one of the things that was really actually insightful here for me is when we're looking at the graph on the left on the Sharpe ratio. And what we're seeing there is, I mean, if we just trained the ML model, it gave us a value between 0 and 1. And we just kind of accepted the default value of 0.5. What you see is that you're not actually maximizing the Sharpe ratio by doing that. We see that as we kind of move that threshold and say, hey, don't take any positions up to 59%, we find that, hey, at 58%, that's really where you squeeze out almost an entire extra 1 on the Sharpe ratio. So at 0.5, the Sharpe ratio is like 1.95, but then at 0.58, it's at 2.7, 2.8. So that's a significant improvement. It was showing, by way of example and experiment, that so much money and risk can be mitigated, more money can be made. You can make your trading strategies a lot more profitable by focusing on optimizing how we're taking positions. And so we really hope that this paper try to provide a couple of ways in which that can be done, right? It can be done through applying meta labeling. It can be done through the fixed or trained position sizing techniques. We're showing here that even if you don't do that and you just adjust your threshold, understanding that relationship between the threshold and your Sharpe ratio, the threshold and the drawdowns adds a lot of value. Like if you're not applying, just doing probability calibration and understanding, what is the shape of your curves, your calibration curves, all of that adds a lot of value to you as a quant making a decision of how exactly should we size positions for this trading strategy. And I think there's a lot more research here to be done. I just think, we touched on a lot of different subjects and try to provide, extra nodes for people to latch onto for further research.
No, just on that, I think, basically with position sizing, it doesn't necessarily have to be from meta labeling. If it's, a probability, or you have any kind of strategy that can produce it. Meta labeling is just a very great way to get to these estimated probabilities of a profitable trade. And then finally, I just wanted to include these two methods as well that we tested. The first one is the Kelly criterion. I think when you think about probabilities, you know, and bet sizing, you know, precision sizing, you immediately think of the Kelly criterion. So we just took the normal one, you know, the classic Kelly criterion, where you have, for example, this C and A, which is the average percentage gain or average percentage loss, and you plug it in with the probability, and then you get the precision size. However, as Doc mentioned, it gave us very large, you know, leverage amounts, or you know, and with our restriction of having a leverage of 1, basically it said if the probability is above, I think it was 0.48, then it just equates to a all or nothing approach. So if, I mean, I'm sure there is something to delve into there to get it better, using maybe the, you know, the continuous form that was also in that book about Thorpe. I think he was the one that invented that.
Yeah. So Ed Thorpe talks about that, but for me, I really think the way to go about this is doing the risk constraint Kelly. Like, we know full Kelly is going to, you know, go over leverage, and in our experiments, we didn't want to provide leverage because we felt that gave it an unfair advantage, right, and made it hard to compare apples with apples. But I do think the risk constraint Kelly is going to give us much more reasonable results, but I think you probably require a full paper just dedicated to that approach.
Yes, exactly. And the last one, this was also thought of by Ilya, implemented, is the linear optimal precision sizing, which is very similar in nature to the SOPS method. And in this case, we only actually want a linear model, you know, a linear slope basically, that maps the probabilities into precision sizes. And when we did that, it did produce a good Sharpe ratio. So again, you're optimizing for the Sharpe ratio. However, it produced a quite small precision sizes. And I think maybe what you can do is, you know, maybe optimize for the maximum drawdown, or even if you want to go for returns, optimize for the returns. Okay, great. That's it. Thanks everyone for joining. If Jock, do you have maybe any concluding remarks?
No, I'm going to stop the recording here, and then we'll stop to answer everyone's questions.